Hello everyone, welcome again to Hybrid Accounts, and this is part 2 of IFRS 2 share-based payment. So we are going to proceed. First of all, we did part 1 on equity settled share-based payment, and now we're going to deal with cash settled share-based payment. Share-based what? Payments. All right. So you saw well how equity settled share-based payments are made, and now we are back to cash settled. So what is cash settled? The main difference in cash settled and equity settled is that on equity settled, you have equity as other components of equity before, and then at last, at vesting date, you convert it to the actual equity components like the share capital, let's say, or whatever remains goes to the share what? Share premium. But for the cash settled now, you would have a liability, and ultimately you would have to go on and settle that what? That liability by giving out the cash. Settlement by what? By cash, right? So the company would have to pay and give out the cash. So that's all. So what matters most here is that in the exam, when you read the question, you should be able to know when the equity instrument, when the instruments, the financial instruments given or the instruments given, whether they are cash settled instruments or they are equity settled. What instrument? For example, the share options, which are common in the exams, would be the equity settled. But actually, you can have other examples of cash settled, right? Like you can see a share-based payment transaction. For example, something called share appreciation rights, right? What happens on share appreciation rights? Employees become entitled to the future cash payment, but based on the increase in the entity's share price from a specified level over a specified period of what? Of time. You see, so employees become entitled to cash payment. They would be paid cash, but that one would depend on the entity's share price. And so employees would be encouraged to work harder and harder, right? But also it could be in this form, the right to shares that are redeemable. Maybe you have the right to shares that are redeemable. You know, shares that are redeemable, it means they have to be repaid. So the cash would still be given out. That's why you say cash settled. It is going to be settled in what? In cash. That's entitling the holder to a future payment of cash. So whatever is made here entitled the holder to the future payment of what? Future payment of cash. Future payment of what? Of cash. That's our point here, right? So you should know those things. The accounting treatment is just like for equity settled, with the main difference being that for equity settled, first of all, recognize the equity in other components of equity, but here recognize the liability. You know, when you recognize equity, it means the company does not have an obligation to give out cash. But when you recognize a liability, it means the company has an obligation to deliver what? To deliver cash, right? So on the debit side, it's as usual. If it's an asset, you would have an asset. If not an asset, you would recognize an expense, just like that, right? And then you go back just like for equity settled. We need to, if we do recognize these ones, we need to know their worth, right? How are you going to measure their value to have their value in the books, right? We resort to measurement. Okay, on equity settled, we use the fair value of instruments at the grant date. But since this is the liability and it is settled in cash, we should have a reflection of the actual value. And so we would be taking the fair value at the end of each period rather than basing for all the years on the fair value at grant date. We won't do that, right? We'll be dealing with the one at the end of each period. For equity settled, we consider the value at the beginning of the period, right? But for cash settled, we consider the fair value at the end of each reporting date, right? So like you see, which is different from what? Equity settled, right? Okay, so we can just proceed here and we are told allocating the expense to reporting periods. We're going to see that, right? An expense is reported as a difference between liabilities. For equity settled, it was a difference between equities, but now it would be a difference between liabilities on actually succeeding periods, right? Okay, so let's look at this illustration and get a picture of what I'm going to show, right? It's the same, just like if you did equity settled, you should be able to deal with cash settled share-based payments with just minor tweaks. Okay, an entity has a reporting date of 31st December, so it reports at the end of the year. On 1st January, the entity grants 100 share appreciation rights to each of its 300 employees. So how many rights in total? 300 times 100, right? Because it's 100 per employee and we have 300 employees. So 300 times 100 is like 30,000, right? On the condition that they continue to work for the entity until 31st December 2023. How many years? Whole of 20x1, 20x2, as well as 20x3, so 3 years is that service condition. Whoever will have left by that period won't be able to exercise the right. Okay, now further information. During 20x1, 20 employees leave. The entity estimates that a further 40 will leave during 20x2 and 20x3. I hope you can see this question now, right? So in the first year, 20 have left, and we expect a total of 40 to leave in 20x2 and 20x3. Whenever we read this question, make sure that you have information for both years, year 1, year 2, and year 3. They would give you in whatever way possible, right? So I would say in year 1, 20 have left, and expect further 40 to leave, so a total of 60. At the end of year 1, I'll get the picture that, oh, I expect a total of 60 to have left after all 3 years, right? So how many employees do I remain with? 300 minus what? Minus 60, which is 240. So at the end of year 1, I would expect to remain with 240, right? Employees. During 20x2, 10 employees leave. The entity estimates that a further 20 will leave during 20x3. So this is information for 20x3 alone, right? So you have to, for 20x3 is 20, 20x2 is 10, for 20x1 is 20. So the picture we have by the end of 20x2, you'd say that 20 left in last year, 10 have left this year, which gives us 30. But 20 are expected to leave in the next year, 20 again, which gives us 50. So 50, by end of year 2, I expect that 250 would have left. And since I had 300, 300 minus 50, I remain with 250, just like this, right? Okay, during 2023, 10 employees leave. So you know that at the year 1, 20 have left, year 2, 10 have left, and the year 3, 10 have left. Gives you a total of 40. 20 plus 10 plus 10, it gives you 40. So you are totally sure that only 40 have left, but I initially started with 300, so I only have 260 employees with me, and these ones will be right to exercise their rights, right? Okay, so let's go on and see how we recognize this, right? So the fair value, we are given the fair value of the share appreciation rights at each reporting date. Now you see, for equity settled, we use the fair value at the grant date, which is at the beginning of this period, period 1. But now, for cash settled share-based payments, we use the fair values and at the end, at each reporting date, at the end of the year. So year 1 is 10, year 2 is 12, year 3 is 15, right? Required, calculate the expense for each of the 3 years of the scheme, and the liability to be recognized in the statement of financial position is at 31st December for each of the 3 years, right? So we need the expense and the liability. Okay, so you go on and do exactly the same thing, like for equity settled. You need to know the total number of share appreciation rights, right? Okay, so you need to get the total employees first. Year 1, it was 240, year 2, 250, and year 3, 260. You got that already. So like you can see, this one is 240, this minus this 240. Year 2, this one is 250, and this one is 260, right? Okay, after having these employees now, you multiply by the rights per employee. Each employee had the right of 100, right? 100 rights. And after that, now you get the total number of rights. Now, each right is worth how much? You look now by the end of year 1. By the end of year 1, you have this 10, which is the fair value, right? Year 2, 12, and year 3, 15. You see now for cash settled, you base on the fair value at the end of the period. While for equity settled, you base on the fair value at the grant date at the beginning of the period. And just one, not for each period, right? Take it at the beginning of year 1 and you put it for all 3 years. But for cash settled, you take it at the end of the period and for each period, because you know we have a liability, so it has to be settled in cash, and so it has to be very well reflected, reflect the cash flows that are expected to be given by the entity, right? So that's why I multiply by 10 here. For year 2, it should be 12. For year 3, it should be 16. And here we have our rights 100 and 100, just like for year 1. Now, for year 1, remember that it is a 3-year period, so you have to apportion, and so you multiply it by 1 over what? 1 over 3 here. For year 2, it should be 2 over 3, and for year 3, it should be 3 over 3, which has no meaning writing because 3 over 3 gives you 1. Okay, for year 1, if you multiply, you'd get 80 here. To get the expense, you take 80 minus the previous liability. Remember, this one is the liability figure, and this one is the expense figure, right? Liability states in the statement of financial position, while the expense states in the statement of profit or loss. So 80 minus 0, because it's not there, you get 80. For year 2, I would have a liability of 200. You know, the statement of financial position combines everything in the previous years. So that's why you take this 200 minus 80 to get 120, which should be the expense for year 2. And for year 3, you have the liability 390. You deduct the previous liability 200 to get 190, which should be the expense for year 3, right? So this one should be for statement of financial position, while this one should be for the income statement, right? We are told not that the fair value of the liability is remeasured at each reporting period, and at the end you take it. While for equity settled, we measured it once and at the beginning of the period, which was the grant date, right? Just like that, I hope you got something there. All right. Now let's speak more on the value of share appreciation rights, right? We are told here that share appreciation rights may be exercisable over a period of time, right? Maybe you may say that, okay, you know, for example, share options, which you looked earlier, we said that actually we wait maybe after 3 years and then we can exercise. But these share appreciation rights may be exercisable over a period of time, not necessarily at one point, right? You know, even for share options, it depends. There are share options for UK and for US. They are very different. Others may be exercised at any point, but others are only exercisable at a particular date, right? So share appreciation rights can be exercisable over a period of what? Of time, over a period, right? Not just once, not at a single point in time. The fair value of share appreciation rights now, it has two components. It got the intrinsic value, but also it has the time what? The time value, which you would have to consider. What do you mean by time value? You know, as the time gap is closed, if the time value diminishes, and so at the end, you would have the two values equal, right? I can show you something here before proceeding to get what I mean. For example, you can see here, you have the fair value of the share appreciation, right? And you have the intrinsic what? Intrinsic value. You see here, this is 5, nothing was given here. This is 8 at the end. This is 10 and this is 10. You see at the end they are matching. So you're going to see what I do mean. I hope you can concentrate now because I'm showing you that at the end, they would be matching, right? So just stay tuned. We finish up with this little explanation, then go to the perfect example. So what is intrinsic value now? And what is the time value? Time value is easy. It's just based upon the fact that the share price will vary over time. Of course, it's going to vary over time. That's no big deal. But intrinsic value means the cash amount payable based upon the share price at that date, right? That should be the cash amount that is payable based upon the share price at that what? Okay, at that date, what should be the price? What should be the cash amount payable at each particular date, right? Okay, now what to know here is, you know, we are just trying to exercise now, right? We have learned how to recognize the expenses and assets in case it's there. And now we go and learn how to exercise when actually the vesting date had reached. So when they exercise, they are accounted for at their intrinsic what? This is the point now. When you exercise them, you account for them at the intrinsic value at the exercise date. They are counted at the intrinsic value at the exercise what date? Because the exercise over a period of time, it will depend at what point you do exercise them, right? So depending on your date of exercise, you would go and look at the intrinsic value at that date and then do exercise. So that's what we're going to do. Whenever you exercise, you look at the intrinsic value at the particular date and you finish up with the double entries, right? Okay, here you're told the fair value of the share appreciation rights could exceed its intrinsic value. At this what? At this date. As I told you, the time value would go narrowing, and at the end they would be equal. This is because the share appreciation rights holders who do not exercise their rights at that time have the ability to benefit from the future share price rises, right? Yes. Okay, at the end of the exercise period, now we are told the intrinsic value will equal to fair what? Its fair value, and so the liability will be cleared, and any remaining balance taken to profit or loss. All right, this is just kind of an accounting treatment, but you don't need to worry about that. You are going to see it practically. Okay, let's read our question here. On 1st January 2024, Growler granted 200 share appreciation rights to each of its 500 employees. So a total of how many rights? 200 times 500, how much? Kind of 100, right? 100,000. Okay, right. On the condition that they continue to work for the entity for 2 years. So this is the service condition. At 1st January 2024, the entity expects that 25 of those employees will leave each year. You see, so we expect that this is at the beginning. At the beginning, it doesn't matter. I told you to get the picture of employees that will leave, you look at the end of the year. Be very careful with this. Again, be very careful with this. During 2024 now, 20 employees leave, which is the first year. 20 employees leave. Roller, the entity expects that the same number will leave in the second year, all right? So during the first year, 20 leave, and you expect 20 to leave in the second year, giving us a total of 40, right? So how many employees do you expect to remain with? Is 200 minus 40, which is 160. So we expect to remain with 160 employees after year one. During 2025, the second year, 24 employees leave. Okay, so we get the complete picture now. 20 left in year one, in year two, 24 left, so 44 left, right? If 44 left, what do we remain with? Is 200 minus 44, which is 150 what? 56. So we have the estimates of our employees. Year one and year what? Year two, right? The share appreciation rights vest on 31st December 2025. You see now I told you that they could be exercisable at over a period of time. So they vest. It means that from 31st December you can exercise them, right? But not necessarily to exercise them right away from that on that point, right? So they vest. By vesting, it means they are ripe on this stage, so you can exercise them from at any point from this point, right? And it can be exercised during 20x6 and 20x7. It has been taught well specified. If only 20x6 and 20x what? X7. On 31st December 20x6 and 257 of the eligible employees exercise their SARS, right? You see now, we have only, oh, sorry, I say, I'm very sorry. I did something wrong here, right? I'm sorry. I read wrongly here. We had 500 employees, not 200 employees, 500 employees, right? So yeah, I should say that 20 left in year one and 20 more were expected to leave in year two. So it should be 500 minus 40, which is 460, right? And for year two, year one, 20 left, 24 left in year two. So a total of 44 left. So 500 minus 44 will remain with 456. I'm sorry, I misread. Okay? So this is fine here. So we are told on December 26, 257 employees exercised their rights. So only 456 had the right to exercise, but only 257 exercised in full. The remaining eligible employees exercised their SARS in full on 31st December 20x7. So others expected until 20x what? X7 to exercise, right? And we said they exercise at the intrinsic value, right? Okay, now you're told the fair value and the intrinsic value of which SAR was as follows. You have the reporting date, 20x4, x5, x6, x7, the fair value per share appreciation right, and the intrinsic value have them. Of course, you need the intrinsic value for 20x6 and 20x7 because these are the dates you have to exercise, right? That's why they are only provided for these 2 years, right? Okay, now, let's proceed. What are we required to do here? Required A, calculate the amount to be recognized as an remuneration expense in the statement of profit or loss, but also the liability in the statement of financial position for each of the 2 years to the vesting date. Okay, the first part is normal, right? The first part is very, very normal, just like we did in the previous example. What are you going to do for the first part now? So you just do the same thing, right? You just take your share appreciation, right, which is 460 per employee. how many employees? Sorry, you have 460 employees, times the share appreciation rights per employee, which is 200, and then you multiply by the fair value of the share appreciation rights at the end of each year, which for the first year here, 20x4, it's 5, and for the second year, it's how much? It's 7, right? Just like that. Then you time apportion and everything gets done, right? Okay, let's go and see the solution here. You can see, right? 500 minus 20 minus 20, which is 460, as I told you. Total employees, you multiply by the rights per employee, and then you multiply by the fair value, right, of the option at the end of the year, which is 5. So for the second year, you multiply by 7, right? For the second year, 500 minus 20 minus 24, which is 456, as I showed you, times the share appreciation rights per employee, times the fair value per what? Per share appreciation right. Then you time apportion. Remember to time apportion like I told you. This was a 2-year period. For first part, this is the first year, so you have to say times 1/2, which is the total years, right? And for the second part, it should be times 2/2. And so you get 230,000 here is the liability. To get the expense, I told you, take this liability, you minus the previous liability. For our case here, it's 0, so you get the same figure. For the second year, you have this figure here. You minus the previous liability, and you get this one, which is the expense for year 2, right? Doing that, and everything would be fine, and then we'll have to go to part 2 now. Okay. Part 2 now, which is our main reason here, says calculate the amount to be recognized as a remuneration expense and reported as a liability. Calculate the amount to be recognized as a remuneration expense and as a liability in the financial statements for each of the 2 years for 20x6 and 20x7. Now note that 20x6 and 20x7 is the day. These are the periods which people can exercise their rights, right? The rights can be exercised. We say that the rights are exercised at what? At the intrinsic value. So that's what we're going to do. Okay, so now you can see at the end of the year, at the end of 2 years, how many employees, how many people had the rights? We only had 456 employees, right? Which you also saw here, 456 employees. 500 minus 20 minus 24, it's 456. You see, we had 456, but we are specifically told that only 257 exercised their rights. So there are those who exercised their rights and those who did not exercise their rights, right? So we had 456, but 257 exercised. So if you remove the ones who exercised, what are we going to remain with? Should be here, you should have 9 and 9 again, and here you should have 1. So these ones exercised and the remained is 199. So 199 remained is the liability, while these ones exercised, provided with the cash, right? Okay, so it's just a normal thing here. You can see we had 456 like I showed you before, 257 is exercised, 199, right? Remained. Okay, so if you start with 20x6, this is what we're going to do. It's very simple, you know. Remember, just like you did for equity, settled share-based payment, remember you have in the statement of financial position, you have this carrying amount of the liability, right? For this year, and you also know the balance of liability for the next year, which is 408, right? But now you have this balance of 5038, right? So you could come and say, okay, this is fine. Right now, I have the balance of this liability, but I'm going to extinguish it because I'm going to pay, right? How many people am I going to pay? We said it's 257 exercise, so I'm going to pay to give cash to 257 what? Employees. At what price am I going to pay? We said we settle at intrinsic value. At 20x6 now, the intrinsic value is 7. You see, this is the intrinsic value, what? 7. So you say, that's why you can see, you say 257 times 7, right? You can see it here, 257 times what? Times 7. But remember, these are just the employees. We need to know the number of options, the number of rights per employee. Each employee had 200 rights. So you multiply them and you get this figure here. So this is what would be as cash. And so this liability would be reduced by this much amount, right? You know, in case maybe you did you can have your T account here, right? You have the debit and credit side. So you could say, initially I opened with my liability of 638. I'll just write it simply this way, right? 638. This is the liability account, right? This is the liability what? Just say this is the liability account. If you settle the liability, you pay, it means you credit cash and you debit the liability account. So obviously this 359 would have appeared on the debit side, right? This, right? After this, now you say, okay, what balance do we remain with? Remember, 257 were paid, but 199 remained intact. So we still remain with the closing balance. Now you know if the liability has a credit nature, if the opening balance is on credit, the closing balance would be on what? On debit. So the closing balance of liability would stay on the debit here, right? Of 199 employees, right? So you say those 199 employees would still remain. Each one was actually to be provided with 200 share appreciation rights, right? And you can see now it has been multiplied by what? By 8, right? What is that 8? 8 is that figure which we already had here, right? It's here. Get that point? We say the liability is also usually measured at the fair what? At the fair value, right? So you multiply by that figure here is 8, and then you get 318, 300 and what? And 18, right? Okay, so if you try to get the balancing figure here, it will be on credit. And being credit on the liability side, it means it is a debit on the income statement. And so we would have to recognize this figure, right? I hope you got that right. Yes. So after having this one, I think everything would be fine. And then for the second point now, for 1st December 20x7, you do the same, right? We are told here We are told here that the remaining eligible employees exercise their rights in full on 31st December 2007. So on 31st December 2007, nothing remained payable, right? So this liability of 318,400, which you see here, was totally extinguished. This was the opening balance. The closing balance was nil. What did we pay? As usual, you pay 199 employees. Each one you pay 200 what? Rights. At what price? At the intrinsic value. What was the intrinsic value of 27? It was $10, right? So you multiply by $10 here and you get this figure, right? So you'd have this one on the credit side, this figure on the debit side, and the balance would still be on the credit side again, 79,600. You can do the T account if you wish, right? Yes, you have that option. So it's just fine. Okay, let's go back now to our notes so that we complete this. Okay, we have other issues, right? All right, we have these other issues to deal with here, right? Okay, for other issues now, we can say that we have, like I told you, hybrid transactions, right? You have the hybrid transactions. Hybrid transactions are those transactions which I told you before, right? Where they could be either equity settled or cash settled, right? So we say, let's speak of the entity choice now, right? If a share-based payment transaction gives the entity a choice over whether to settle, choose. You either settle in cash or issue equity instruments. In cash, it should be cash settled. In equity, it should be equity settled. The scheme should be accounted for as cash settled. If the entity has an obligation to settle in cash, obviously, right? And then it should be, if no obligation, if there is no obligation, it means the entity should treat this as what? As equity settled. So just look for an obligation to uncover what you have to do, right? But now, when you deal with these ones, there are usually two possibilities. It's either the entity is given the choice to decide, or the counterparty, let's say the employee, right? Or the service provider, or maybe the provider of products is also given an option, right? So first of all, we spoke on the entity choice. If the entity has to choose, it has to do that. If no obligation, equity settled. If there is an obligation to pay cash, cash settled, right? Okay, what about what if when the counterparty has that option, what is going to be done? Now we say some entities enter into share-based payment transactions that give the counterparty the choice of settling in cash or in equity. So the counterparties decide how they should be paid, right? In this case, now the entity has granted Jina kelele. In this case now, the entity has granted a compound instrument, and so the credit entry must be split between equity and liability. You see the point now. So when this entity has a choice, it should either be an equity settled or a cash settled. But when the counterparty has a choice, you can see now, right? The entity has to break this down, right? Because it is a compound instrument. And one of the compound instrument has both the elements of equity and what? And liabilities, right? So this is what we're going to do. Now, you look further. In case the transaction is with the employees, the equity element is calculated at fair value of equity instruments of equity alternative at the grant date, less the fair value of the cash alternative at the what? At the grant date. So that's what you do, right? In case it is with what? With the employees. Take the fair value of equity alternative at the grant date, less the fair value of cash alternative at the grant date. But in case the transaction is not with the employees, the equity element is calculated the fair value of the good or service received. I think you do remember we did this very before on the equity instrument, right? On the equity settled, I mean. Less the fair value of the cash alternative at the date of the transaction. So the fair value of cash alternative should always be deducted, right? But here with employees, you look at the date of the transaction, right? Not at the grant date. But if it is employees, you consider the grant what? At the grant date. But also you're told the liability element, how do you get that now? The liability element is calculated at the fair value per cash settled method. I hope you know for cash settled, you use the liability. For equity settled, you use the equity, right? That's why the equity element is based on the equity settled share-based payment, and the liability element is based on the what? Cash settled, right? It's just like that. Okay? So here we say these amounts will be recognized over the vesting period, which is normal. That's what we usually do, right? Okay, now let's look at the test to understanding number 7, the choice of settlement. What are you going to do with this? Okay, let's read the question and proceed. On 1st January 2024, an entity grants rights to 20 employees. All right, that's fine. Okay, if still employed on 31st December 2026, which is 3 years, right? 2024, 2025, as well as 2026, the employees can elect to receive either 800 options or cash to the value, right? You see now, it is the counterparty that has a choice, not the entity, right? You know, when the entity has a choice, it's easy because if it has no obligation, it just says equity settled. It has an obligation to pay cash, cash settled. So we have gone for the complex example, right? The counterparty has an option and not the entity. So the employees can elect to receive either 800 options or cash to the value, right? You see, so it's kind of both equity. 800 options is the equity. Cash to the value is just the what? The cash settled. On that date of 700 shares, right? The fair value of the options is $19 at the grant date, okay? The reporting date is 31st December. So the year ends as usual, is the norm. The following information is available now. We have the share price here, but also we have the expected investors, right? Okay. 1st January, you have the share price to December 26, and you know the expected investors. Okay. So now let's go on and look at the requirement. We are told here, calculate and explain the impact of the share-based payment on the financial statements for each of the 3 years, right? Okay, we need to see the impact of the share-based payment on the financial statements for each of the what? Of the 3 years. So let's go and look at this. This is test understanding number 7. And here we are. Okay, now first of all, you need to look, right? You see whether the entity has a choice or the counterparty has a choice. On your case, it is the counterparty that has a choice. If the counterparty has a choice, you treat this as a hybrid transaction, a compound instrument, right? Break it down into a liability component, but also an equity component. In case the entity had a choice, you would choose. It should be either a liability or equity, not both of them, right? Okay, so that's the first thing. So the employees have a choice of settlement. It's the employees that have the counterparty. So they can take settlement in equity instrument or cash. And so when accounting for the share-based payment, the credit entry must be split between the equity and what? Liabilities, right? The debit is obviously an expense. It doesn't matter whether it's an equity settled or cash settled, it's either an expense or an asset, right? Okay, let's go now on how to get the equity. We learned how to get the equity elements, but also to get the liability component. The liability component is done just like for the normal cash settled, right? But the equity component, we follow the equity settled, but we follow the principles, right? So the fair value of the equity component, how do we get it? The fair value of equity alternative at the grant date less the fair value of cash alternative at the grant date. We do the same. How do we get the equity alternative at the grant date now? I hope you know the grant date, right? Let's go to the grant date. The grant date is what? On 1st January, and if you're still employed, we are told that the employees can elect to receive either 800 options or cash to the value at that date of 700 shares. You see, so for equity, you have 800 options. For cash, you have 700 what? Shares. That's what you can see here, right? You can see for equity, you have 800 you consider, but for cash alternative, we consider the what? The 700. What matters here is what do you multiply with? If you speak on the word equity, right? You can see here, fair value of equity at the grant date, less fair value of cash. So we just need the fair values. How do we get that now? Now, the fair value at the grant date. The grant date is 1st January. What is the fair value at 1st January of our options, right? Our options, we are told the fair value of these options, these 800 options here is 19. So you'd have to say 800 times 19, right? And what about this cash? This one. 800 times 19, you get 15,200. How do you get the fair value of the cash alternative at the grant date? You need to know the worth at the grant date, right? Or the cash alternative, right? Grant date is 1st January. You have the 1st January here, right? And you know that if you are given the cash, you would see, okay, the share has a value of 21. So I'm going to receive 21, right? So 700 times what? Times 21. If you do that now, you take the difference, 500 to 100, 15,200 minus 14,700, and you will have 700 per what? Per each employee, right? So this should be the fair value for each what? For each employee, and then you can proceed, right? You already know what each employee would receive, right? So if you know that, I think the remaining one would be easy, right? You know how to deal with that, right? This should be the equity component, and we have learned how to deal with the equity settled share-based payment, right? So you know that you'd receive 500, but now you look at how many rights were provided for each and how many employees were there. You can see here, right? You have 200 what? You have 200 what? 220, you have 20 what? Sorry, not 200, it's 20 employees, right? Remember, on equity settled, we said 20 employees, let's say times these options per employee and what, but this 800 has already been multiplied, right? So you don't need to worry about that. That's why we just take 500 times 20, right? And then after that, you apportion it, right? The condition for 3 years, 1st January 2024 to 31st December 2026, which is 3 years. So you would have to multiply by 1 of 3. This is the first year, and to get this one, right? For the liability component, it would be obvious. You know, the liability component doesn't have a lot, right? You just go direct, right? The liability component, I hope you know how you deal with the liability component. First of all, you have the last year, yeah? The last component here. Okay, you go and multiply, right? With the value of the liability. What is the value of the liability? Let's go and look for it. The fair value of the price here is December. Remember, this is the first year, right? 27, right? Remember, it's year one. You have this value, and then you multiply by the remaining figures now, right? Yes, because we usually say the number of employees times the rights per employee. How many employees? 20 employees. How many rights per employee? 700, right? How many shares? 700. So that's why I would say 20 times 700 times 27 times 1 over 3. Remember, for the liability component, we base on cash settled. And for cash settled, we usually multiply by the fair values at the end of each period, not at the grant date, right? So you do this, and so you'd say this is the equity component, and then you would also have the what? The liability component. So you credit your equity at this figure, you credit your liability at this figure, and the balancing figure would go to the expense. But as I told you, we usually take this total year of equity and the liability minus the previous. We do not have the previous, so we just copy it as it is, right? For the next year, you're going to do the same, right? What are you going to do with the first year? Exactly the same thing. You need to get the equity component, but also you need to get the liability what? Component, right? I hope you saw what we did here, right? You saw what we did here. So we're going to do the same thing on the second year. So what do you do with this? Second year, what do you do? The same thing, equity component. This is 31st December 20x5, right? So you have your worth, which is 500, right? Okay, what were the expected investors now? We have the price here. This is 31st December, the second year, and you have the expected investors. We have 18 here, right? It means we expect that by the end of the second year, you have the picture that we would only remain with 18 people when the 3 years end, right? That's why you have the normal here of 18, right? Times, you see the 500 here, that it is that difference which you already computed, right? The first difference. And then you apportion it. This is the second year, so times 2 over 3, you get 6,000. For liability component, no worries, just do it. You do not need to take this one, you just get it direct, right? So you'd have 18 here, and then you multiply by this number of shares, 700, and then we finish up, right? You multiply by the fair value at the end of which respective year. This is year 2, 20x5. If you come on 20x5 here, you find that this is the price at how much? 33, and then you apportion it by 2/3, you get this one. So you do the same, copy this one, on equity, you copy this one here, and how do you get this now? You need to know how to get this figure, right? How do you get the profit? Like I told you, to get this profit, this one shouldn't be a problem at all, right? Since here now, you already have, for equity, you already deducted here, so you shouldn't worry now, like what we did before. So what you have to do here now, you will have your equity, and you see how, you know how to get it now, right? Because you already have the 6,000 here, and then you already have the previous, which was how much? 33. So you deduct them and you get your net figure here. And for liabilities, you do the same. You have this figure here and you deduct the previous one, you get this one. So be very careful when you deal with these elements here, right? And then for profit or loss, we just add them together. So you can just see how the approach has been a bit different to what we are doing before. So when you do this complex transaction, this is what you do. Deduct these ones and then proceed, right? Although we know this will be our actual liability. So this will be our actual liability component. What we are just trying to do here is just to add these ones together so as to get the profit or loss, right? This is what will be the change in equity and the change in what? In liability. But we can do the same way like we did before. It's just fine, right? Okay. And for the last year, you're just going to do the same again, right? We're going to deal with equity now. How do we get the value of equity? We already have this 500 as the difference. So what we do now, you already have the weight, so you need to know that price. Those people who would still remain by the end of the year, year 26, we have 17. So I would take 17 times 500 times 3 over 3, no need to show it, you leave it. Then you go to the liability component, you multiply all your figures, right? You have 17 people. Each one you expect to pay them 700 each year, and then you look at the fair value at the end of that period, which is 42. You look 26 here. So after doing that, you multiply by 3 over 3 and you get this figure here, right? So the same, to get the change in equity, you can see the changes, right? Right now you have 8,500. If you compare with the previous one was 6,000, right? It was six what? 6,000. So this one, it was 6,000 here. You deduct, you get the net. And for the liabilities, do the same. You have this figure here, deduct the previous one, 277, 200. You get this one, you add them together to have your profit or loss, right? So this is what you'd have to do when you do undertake this kind of questions, right? Okay, now let's go to, these are just like summaries, right? Group share-based payments, right? You have group accounting. Now, how do you account for share-based payment when it comes to group accounting? You have a subsidiary, and maybe, let's say the parent is paying for the subsidiary. The subsidiary might receive goods or services from employees or suppliers, but let's say it is the parent that has issued the equity or cash settled share-based payment. You see now, because they are one thing, the subsidiary has the customers, right, has the employees, but it is the parent that is going to issue those shares. So how should we issue them? Should we consider them on the side of the subsidiary or on the side of the parent or what? Now, as per IFRS 2, the entity that received these goods or services in a share-based payment arrangement must account for those goods or services irrespective of which entity in the group settles. It makes sense, right? Even if it is the company that settled, the specific entity that received the goods or services should account for that. It's a very important point to note. Or whether the transaction is settled in shares or cash, so it won't matter. So if the subsidiary received those goods, it is a subsidiary that should deal with that, right? Regardless of whether it's a parent that paid or not, right? And so you have maybe the other disclosures, whatever you've done there, the disclosures. Disclosures is just keeping something open. And explaining all that is like putting something open because it is even shown in the financial statements, right? Income statement of financial position. But there are additional ones. The main disclosures required by IFRS 2 are you should describe a share-based payment arrangement. Of course, it's either cash settled, equity settled, maybe it's a hybrid payment, hybrid transaction, right? Explain it. Then the number of share options, the way we are computing, we are going to give one by one, right? Number of share options granted or exercised during the year. Maybe these ones were granted, maybe these ones were exercised. Total share-based payment expense. We have shown all those when computing. IFRS 2 requires disclosures that enable users to understand how fair values have been what? Have been determined. Of course, they should know because only fair values are used here. And so if there is no way of knowing how they have been obtained, that one would be a problem. That's fine. We are done with this topic of ours. Thank you very much for being with me. These ones are just the normal references on the investor perspective on conceptual framework. So you can just go through this one just for. All in all, I hope you know that the standard overrides the conceptual framework. That's the main point, right? So you should very well stick with that. All right, it just tells you that the conceptual framework defines an expense as a decrease in economic benefits. Let me tell you in short. In case what a standard defines is different to what the conceptual framework says, that's fine, right? A conceptual framework is there just as a guide to make sure that standards are prepared well, right? That's why maybe it can show recognition criteria, it could show measurement criteria, it could show, let's say, how to disclose matters, how to present matters, but it won't restrict. It's like IS2. IS2 has deferred liabilities or deferred assets. Consider framework specifies the liability as a present obligation. But if it is a deferred liability, it means that it's an obligation in the future. But we don't care, right? We don't give a damn, we don't care because what we need to know is that the standard would always override the what? The conceptual framework. So the framework defines an expense as a decrease in economic benefits that result in the decrease in equity, right? Other than those related to the distribution to equity participants. But in the case of cash settled share-based payment, you can see the entity has an obligation to pay cash in the future. You see now, this is what I told you. It speaks of the future, while the conceptual framework actually usually focuses on the present, right? So this is clearly meets the definition of what? An expense, right? I hope you got that now, right? So in the case of equity settled share-based payment, the entity is providing equity as a payment for the good or service. And there is therefore no reduction in an asset or increase in what? In liability, because the entity is providing equity as a payment for good, right? So we don't touch asset or liability in accordance with the definition of expense. So IFRS 2 requires the recognition of an expense for equity settled schemes with employees, but it can be argued that this is not in accordance with the definition of the framework. So this is just normal. It could be that the standard goes against the constitutional framework and it won't be a big deal, right? Okay, just keep following us up and you're going to gain much and much. And thanks for the support. You can subscribe. You can let others know more about this channel. All right, until next time.